Hi everyone, Beth here. I've created a couple of income statements for a company that I've called the Lunchable Company. Okay, you can see here that it's an income statement where it shows their revenue and their expenses. And I've created 2 months, one July and one August. And as you can see, the most recent month is the one that I have put closest to the words. Okay, so because it is the most relevant, because it's the most recent. Okay, so I'm going to do a little bit of a refresher on income statements. Not sure when the last time was that you looked at these, so I thought it would be good to review. Okay, so we start with revenue. Revenue being the exact same thing as sales. It depends on the company whether or not they call it revenue or they call it sales. Minus COGS. Okay, so for some of you, if you haven't done accounting 2, financial accounting 2, this is going to be a completely new term for you, okay? But what COGS stands for is, let me write it out here, cost of goods sold. So in accounting 1, if you remember, we looked completely at service type industries, providing a service for a client or a customer. In financial accounting 2, that's when it was introduced, companies that actually sold stuff, okay? So that would mean, say we sold coffee mugs. So for that, you would have an inventory. I'm sure many of you have been involved in inventory counts for any retailers that you've worked for. Seems to be a common theme when I mention inventory, that's what individuals equate it to. So anything that's on the shelf in a business, brick, or we could be talking Amazon, it's inventory. So as long as the company owns it, it's considered inventory. It's an asset, something they own, okay? But then as soon as it's sold, so think of going into Walmart and having a cart full of stuff, walking up to the point of sale system if you do your own self-checkout. As soon as your item goes bleep across that screen, it records the revenue for Walmart, but it also records the cost of goods sold. So say you were buying a package of spinach. So you go bleep, then it's showing that you owe, say, $6. But then in behind the scene, it takes that item out of inventory for Walmart and it puts it through to an account, which is an expense account, but puts it through to an account called cost of goods sold. And that's what's going on here in the Lunchable Company. Okay, so in July, they had revenue or sales of 1.5 million. And then the cost of goods sold, how much it costs the company to buy this stuff that they're going to turn around and sell. So again, how much, say, let's go back to the spinach. So it's recording sales of $6. When you bleep it across that screen, it shows up on the screen that you owe $6 for this spinach. And like I said, in behind the scene that the customer can't see, it takes that package of spinach out of inventory. And the amount that it takes it out of inventory for is the amount that it cost Walmart to buy it from their supplier. Okay? So that's the amount that goes from inventory into cost of goods sold once that item has been sold to a customer. Okay, so that is the cost of goods sold. And then, so when you have a cost of goods sold item, it's actually, as you can see on the screen, recorded separate from any other expenses. So you've got revenue, and then we minus off what's called the cost of goods sold, and then it gives us the gross profit. So if we looked at a company and it's like, okay, the only thing I sold was spinach. So say spinach was $6. Say the cost of goods sold was $4. then the gross profit for that one package of spinach before any other expenses are taken into consideration, the gross profit would be $2. Okay, so that's looking at that one item. So now, of course, it's recording everything that they've sold for the month of August for this Lunchable company, which is 1.2 million, minus the cost of goods sold for 400,000, and then it's saying that the gross profit for Lunchable company is 800,000. Okay, so now we need to take off all of the other expenses that the Lunchable company has, such as rent expense, supplies expense, wages expense, shipping expense, utilities expense, internet expense, and phone expense. And then if you remember back from accounting 1 or accounting 2, you've got to add up all those expenses to give a line called total expenses, and then to come up with your profit. Or, if you remember, this can also be called net income. You take your gross profit minus the total expenses of 630,000 to give you a profit or net income of $160,000. Okay. So that's a brief overview, kind of a reminder of accounting that you've done in the past, creating an income statement. Again, some of you, there'd be a couple of new words in there, which would be the cost of goods sold and the gross profit. So what I'd like you to do is at the end of chapter 2, if you have the textbook or even the photocopy oh no, sorry, I only was able to photocopy chapter 1. So you will need your textbooks for this. Exercise 2, which is on page 78, what I'd like you to do is create an income statement for, it's called Cougar Inc. Okay, so this is going to be our first step. We're going to create this exercise 2 now based on an income statement that looks like this. And then I'm going to introduce something new, a way to organize expenses for a company that makes it more relevant for the users of the financial statement, the managers. But we'll talk about that in a little while. Right now, I'd like you to give exercise 2 a try, put it in this format, and I will have the solution for you in a future video and also available on Brightspace. Thanks, everyone.